Chinese authorities are mulling a potential rescue plan to help plug a funding gap worth close to $7 billion. The government is considering allocating about 20 billion yuan in local government special bonds to buy unsold homes and vacant land from Vanke to plug a funding gap of about 50 billion yuan. Aside from that 20 billion yuan, Vanke is set to be allowed to seek other financing sources, including loans or issuing new bonds. This comes after Vanke warned it was facing record losses of $6.2 billion last year and a management shakeup, where two executives stepped down. Shenzhen Metro, the biggest shareholder, has taken over the reins of the company. It's a sign of a shift in Beijing's stance. This is something they're doing quite differently from when other private companies like Evergrande were facing default. Perhaps they're drawing the line here, recognizing that this is a state-backed company that is too big to fail. It employs about 130,000 people, and they may be trying to ring-fence the fear of contagion spilling over from private companies to state-owned ones. The $7 billion bailout, it's the first time that local government special bonds are being utilized to bail out a property company. The program is new and only started in October. We see a shift in the stance from the top in trying to halt the housing slump in China. But I think our worry right now is that we are all aware of the $300 million facility to help local governments buy unsold homes, which has been very underutilized. As of September, it was in single digits. Local governments have their own agendas. The biggest problem is that affordable housing projects in China are not profitable in many cases. We're talking about rental yields that are lower than the funding costs for the projects, so local governments aren't enthusiastic about doing it. The next question is, are they going to step in and help buy homes from Vanke to really help its liquidity? In many cases, they're very selective about the projects they acquire. They want projects in central areas, fully unsold buildings, with good transportation links, etc. So, we have a big price tag here, 20 billion yuan to buy Vanke's assets, but how much of it will be utilized? We had 300 billion yuan from the PBOC before, but again, that was only utilized in single digits. Based on the news reports, we've assessed a 50 billion yuan funding gap for Vanke right now. The danger is that the 50 billion yuan is just a snapshot of what they're facing now. But if you look at Vanke's contracted sales in January, they were down 42 to 43%. In the worst-case scenario, if that decline continues throughout the rest of 2025, we're expecting over 400 billion yuan in sales to drop compared to a year ago. This is a dynamic situation, and if sales continue to slow, the price of a bailout will be bigger. So, what we're talking about in the news, 50 billion yuan, might not be enough further down the road. Authorities may need to think about stepping up this rescue to truly help turn around liquidity, which is why you're seeing in the share price right now that investors aren't convinced. They think the 50 billion yuan might buy time for Vanke, but if we want a true turnaround in Vanke's liquidity, more needs to be done. That you're expecting contracted sales to drop by 25% this year, which is significantly higher than the consensus forecast. What's underpinning your forecast? We expect sales decline to narrow from the 42 to 43% we saw in January to around 20% in the second half of this year. But at the end of the day, Vanke is facing a shrinking project pipeline. Land spending last year was down by 85 to 88%. So, the number of projects they can sell is shrinking, and they're also talking about selling homes to authorities, which would further reduce the number of sellable projects. Vanke has 2/3 of its land bank in China's weaker tier, 2 and lower tier cities. So, those markets will continue to be weak, and we expect further price cut pressure from there. It's good to have government rescue measures to buy time, but turning around operations still faces a lot of challenges. I think Vanke is very unique in the sense that it has 25 to 27% of its shares owned by Shenzhen Metro, so it has that state link. That's different from, for example, Long4 or other private developers that need to be solved. So, I think this is a special exception. We need to draw a line and say that we need to prevent state-backed developers from failing because otherwise it risks spilling over to other investors. If Vanke fails, people will start questioning the stability of other government-owned developers.